Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, January 30th. Earnings from big tech are mixed. The Fed announcement was slightly hawkish, while other central banks' decisions are full of uncertainty due to the Trump factor. So get ready, we have a big wrap up today. Alright, so we have an avalanche of macro and micro news to comment on this morning. So let's start with the micro and build it up, if you will. Now, 3 of the Magnificent 7 companies in the US and ASML in Europe released their fourth quarter earnings yesterday, and the numbers were actually quite mixed. So first, the Dutch ASML. Well, they announced better than expected results yesterday, and more importantly, they hinted at a strong order book confirming a continued strength in its AI business for the coming months. So that was a relief for AI investors. The share price gained more than 5.5% in Europe and also regained the levels that it was trading at pre the DeepSeek sell-off. But the announcements were less outright great and positive from the 3 others in the US. So Microsoft, for example, reported a significant boost in its AI segment with an annual revenue increase of 175% year over year. That's a huge number. However, the growth rate in Azure and other cloud services was 31%, slightly below the 31.8% expected by analysts. Now, note that the company, Microsoft, faces challenges in meeting its rising AI demand due to data center capacity constraints, and that's exactly the reason why they are planning to invest around $80 billion in AI this year. But alas, the cocktail of high spending and slowing growth didn't really enchant investors. That actually sent the Microsoft stock price more than 4.5% down in the after hours trading following the earnings announcement from the company after the bell yesterday. Then, Meta exceeded both revenue and earnings expectations when it released earnings after the bell as well, but its current quarter forecast disappointed investors. More importantly, though, the company actually doubled down on its planned 60 to 65 billion of AI investment this year, defying the DeepSeek triggers skepticism about the AI investments and the AI costs, and Zuckerberg actually said that 2025 will make Meta's AI accessible to over 1 billion users. There you go, Zuckerberg. You can't have such big ambitions and buy less than Nvidia's most premium chips, can you? So, the stock price of Meta first fell. It fell on disappointing current quarter forecast from the company, but then it rebounded more than 2% in the after hours trading. So, if Meta pulls off this AI story successfully, then I can tell you that they have an incredible potential to grow as the company has so much data from people in their hand that they will make something incredible out of it. So I like the idea. I am as convinced with Meta's AI ambitions that I was unconvinced with its metaverse bets. Too bad that they changed their name to Meta, right? Anyway, the latest announcements from the AI world, from the technology world, actually shows that the AI growth may be slowing, but it will remain robust still. And Alibaba, the Chinese Alibaba, actually stepped out of the darkness yesterday, saying that its own AI model is the greatest of the world and is performing better than Meta and DeepSeek. Get in, Alibaba. I mean, now the competition is really on, right? And I think that a technology giant like Alibaba should be taken as a bigger threat to the world of AI than DeepSeek, because Alibaba can simply make it worth so much, especially if they can back it up with real world applications and wide adoption. The potential is huge, guys, but the enthusiasm from the investors, remains quite underwhelming to my taste. I actually do like Alibaba, and if you want to get exposure to Chinese AI, if you happen to be willing to do that, I think that Alibaba is actually an excellent candidate to do that. Then, other than AI, Tesla actually missed both earnings and revenue expectations last quarter. But there's always a but with Tesla. The company actually said that it will launch its robo-taxi and pilot production of the Optimus humanoid as early as this year. Then Elon Musk said that Teslas will be in the wild with no one in them in Austin in June this year. So it was a roller coaster ride in the after hours trading because the stock price first fell nearly 4% on disappointing earnings and revenue, then rebounded to print a more than 4% jump on robo-taxi dreams. I don't know if the robo-taxi is the next big thing for Tesla, but I am actually super concerned myself by the company's decision, its earlier decision to drop the supercharger project, and even more so since I'm living in a temporary house with, unfortunately, no supercharger or no charger at all in the garage, and I had to actually buy a fuel-powered car. So it's not a Tesla, obviously, but hey, I mean, the charging stations around me are working 50% of the time, and I just couldn't use my car anymore. And that clearly showed me at the start of this year the limitations of the European EV development. So to say, I am personally less excited about Optimus Humanoid. That won't necessarily change my life or anybody's life by tomorrow, or the robo-taxis. I mean, just imagine how long it will take for a thing like a robo-taxi to go beyond Austin or beyond the US. I mean, in Europe, we barely have chargers, Mr. Musk. But anyway, speaking of all these beautiful things, we should still all admit that Elon Musk is just simply great and impressive for triggering price rallies with lower than expected quarterly results. But be careful still, because Mr. Musk's implication in the politics won't always be a positive push. It remains a risk for the company's stock price. For the price, I actually like Tesla better near $350 per share as an entry level than above $400 per share. Now, zooming out. The US equity markets were down at yesterday's trading session before all these earnings, but the futures are up this morning. The Federal Reserve's decision day went pretty much according to the plan. Now, Fed members actually decided to maintain the interest rates where they are for the first time in 4 meetings after a 100 basis point cut over the past few months, but there was some confusion about the inflation outlook. Now, the Fed statement cited that inflation in the US remains somehow elevated, but they removed a reference regarding the progress of inflation toward the Fed's 2% goal. And that immediately got investors' attention as a potentially significant hawkish shift in the Fed's policy outlook and sent stock prices lower. But then Jerome Powell came up and said that language tweak was only to shorten the sentence and wasn't meant to send a signal to the market. So I will repeat that again. The Fed removed a big chunk of the most important information to markets and to investors from a sentence to shorten their sentence. I mean, I've been doing this job for about 12 years now, and boy, never ever have I heard any such nonsense in my life. This man, well, should know that he could actually move mountains by coughing in between lies. What was he thinking, really? But anyway, what's as impressive is, well, Jerome Powell actually managed to, rectify his mistake probably, and people partially bought into his latest remarks, and the S&P 500 erased some of the knee-jerk losses. But overall, the fact that inflation in the US remains elevated, and the fact that it does not necessarily trend toward the 2% policy target right now, and the healthy US jobs market, the robust US growth, and quite good earnings from the US companies, combined to Donald Trump's tariff threats, led to an unsurprisingly hawkish Fed announcement yesterday. But this being said, the worries were already priced in, so the US 2-year yield didn't move much. It didn't react much, to be honest. The probability of a no rate cut in May, however, rose to around 55%. So at the end of the day, the first rate cut from the Fed is now expected for June, the earliest. But obviously, the Fed said that the data could change that, and we all know that the data could, change many things. Voila, the summary of the Fed meeting yesterday. Now, beyond the US borders, the Bank of Canada cut its interest rates by 25 basis points yesterday, but refrained from giving any additional guidance due to Trump uncertainty. So the dollar CAD remains under positive pressure this morning due to the Trump risk to the Canadian growth that could need the Bank of England's help to navigate the agitated waters. And the European Central Bank will probably do the same, announce a 25 basis point cut today, and will certainly say that if the data allows, if inflation trends allow, they will give further support to their economies. So the euro dollar is under pressure this morning and is inclined to extend losses. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.